Our next lecture session is on the topic of the importance of financial literacy, and it will be presented by Tom Cooney. So let me introduce our lecturer briefly. Tom is a professor of entrepreneurship at the Technological University Dublin, director of the Institute for Minority Entrepreneurship and adjunct professor at the University of Turku in Finland. He is a former president of the International Council for Small Business and of the European Council for Small Business, and was chair of ICSB 2014 World Entrepreneurship Conference. He is a policy advisor to governments, European Commission, OECD, and other international organizations. He is a director of 4 enterprises and works in various capacities with a range of businesses. He has published 11 books and presented widely on the topic, particularly in the area of minority entrepreneurship. So, Tom, the virtual floor is yours.
So, thank you so much for the opportunity to present to the We Get Training Academy. I'm delighted to be here. So, we don't have much time, so I'm going to get straight into why I wanted to talk about this particular topic. Amongst the different roles that I play, one role that I enjoy and continue to work at is I work as a mentor in a marketing capacity, either a mentor or as a consultant with small firms, and usually I go in a marketing capacity because that's my training, that's my background. And when I go into small firms to work with them, the first question I ask is, show me the numbers, show me your monthly figures. And they go, hang on a sec, Tom, you're here as a consultant in marketing. Why do you want to see my financial numbers? And they say, but the reason, to allow us to make better business decisions and for me to understand where the problems might be, I need to see the numbers. I need to see, where you're making sales, where you're not making sales, where you're making profit. And, I can really help you. And what has struck me over the years is that the standard of financial literacy amongst owner managers is appalling. It's shocking. And when I talk about this matter with colleagues internationally, I thought for many years it might have been just a problem in Ireland, but it turns out it's a problem in many, many countries. And I don't understand why owner managers aren't doing this, right? So let me explain a case study that kind of might show you why this is important, right? A couple of years back, I worked with a small firm in Dublin, and they had approximately 800,000 turnover in the previous financial year, with a profit of just €4,000, and there was 10 employees, full-time employees in the firm. So they were working really hard for very little money. Right? So very little in terms of net profit. So I asked the owner manager, I said, what's your number one ambition for the next year? What is it that you want to achieve as number one goal in the year ahead? And immediately he responded by saying, I want to make 1 million turnover. And I said, why? Is that your number one target? And he said, well, it'd be great to go to the meetings, the Dublin Chamber of Commerce, and to say, like, I've got a 1 million turnover company. And I said, that's what I would call a vanity metric. And a vanity metric is a measurement that makes you feel good about yourself, but actually isn't really important to the business. It's just about how you feel. And I said to him, how about we change the number one goal? And how about instead of 1 million turnover, our number one priority for next year is 10% net profit. And so, for example, we might have to lose some clients if we're not making enough money from them. Would you be willing to do that? He said, no, I wouldn't fancy that. And I said, look, would you not prefer to have 600,000 euro in revenue with 60,000 net profit rather than your current situation of 800,000 euro turnover with 4% net profit? Like, surely 60,000 euro net profit is better than 4,000 euro net profit, even if the revenue is down. So we had this debate. And during the debate, discussion came up about one of his biggest clients. Actually, it was his biggest client. And this particular client was a very difficult person. Pain in the butt, really, right? Always really demanding. Work was never good enough for him. Just a difficult client. But the bill at the end of the year was 50,000 euro. And the owner manager sent me, so this client is, of huge value to our business. And I said, how much money are you making from that client? What's your profit on that client? And he said, I have no idea. And I'm saying, whoa. This is your biggest client, and you have no idea how much money you're making off that client. And he said, no. I said, okay, for the next time I come back, can you please go through the numbers on that client, okay, and work out how much net profit you're making off that client. So when I got back for the next meeting, he informs me that when they had analysed the costings on that client, it turns out that the client was costing them 55,000 euro in the previous financial year. So the cost was 55,000, and they were only charging him 50,000 euro. So I said to the owner manager, I said, that's a loss of 10,500 euro. You should be charging that client 60,500. So when I said that it was a loss of 10,500, the owner manager said, hang on a sec, Tom. My maths may not be great. I may not be good at finance, right? But 55,000 minus 50,000 is 5,000 euro. And I said, yes, but if we're to make 10% net profit, we should be charging the client 60,500. And at the moment, you're charging the client just 50,000, so you're losing 10,500 on that particular client in terms of net profit. And I said, because he's such a difficult client, I would even charge him 62, 63 just for being a pain in the butt. Anyway, following the discussion, it became clear that the CEO was committed to revenue as the number one goal with no regard for profitability, well, little regard for profitability, and just wanted to grow the revenue side of the business. Okay, and if it made profit, well, that was even better. So because we had such different philosophies around how the business should be run, we parted ways soon after. The reason I tell you this story is that it helps to explain why I have such a problem with owner managers who don't understand financial literacy. Because what I was looking to achieve with that company was identifying which customers were making us the most money, which customers were making us the least amount of money. Where should we be putting our efforts? Where should we be putting our marketing and our promotional activity, towards? Where should the focus be? And it would allow us to make far better business decisions if we had an understanding of the financials. The other thing that happened in my short time with the company was that the outstanding debtors was shocking. Another big problem with companies, because they're shy about going after outstanding debtors. And I just simply asked one of the staff members, to sit down and go through the list, and anything over 120 days, you phone them immediately. And then between 90 and 120 days were the next list, and then from 90 to 60. And within a short period of time, we got debtors days down to 62 days. Okay. But we also brought in a significant amount of money, which helped the cash flow. So these are simple things. So I'm going to ask you a couple of questions now. Okay. I'd like everyone to have pencil and paper at the ready. I'm going to give you 10 questions. There's a choice of A, B, C, D, or D. And all I'm asking you to do is write down on the page. I'll give you the answers at the end. What do you think are the answers to these questions? So here are questions 1 and 2. So, question 1. Which of the following best describes a fixed asset? Is that an asset that cannot be moved, an asset which will help generate revenue for the business for a number of years, an item in the product range which delivers the same sales volume year after year, or a cost that does not change? Is it A, B, C, or D? Which of the following best defines the meaning of the term cost of sales? Okay, A, the cost of advertising, marketing, promotion incurred in generating sales. B, the total cost that can be directly traced to sales. It includes all costs of purchase, costs of conversion, and other costs incurred in bringing the goods to their present location and condition. C, all costs, including overhead expenses incurred in that period. Or D, the value added or sales tax incurred on sales. So those are questions 1 and 2. Write down A, B, C, or D for each of those answers. And we move on to the next questions, 3 and 4. Which of the following best describes the purpose of the balance sheet? A financial statement showing the assets, liabilities, and net worth of a business at a specific point in time. B, a financial statement showing the assets, liabilities, and net worth of a business over a period of time. C, a financial statement showing the balances outstanding on customers' accounts. D, a comprehensive statement of the financial performance of the business over the year. Question 4. Which of the following business activities belongs in the profit and loss account? The cost of purchasing building premises to house large-scale manufacturing operations. The cost of insuring business premises against fire. The value of money outstanding from customers. The value of new money invested in the business by the owners. So again, for each of these, I'm answering A, B, C. To questions 5 and 6. Which of the following would most significantly account for a difference between the profit for the year and the cash position at year end? A, changes in the sales mix. B, increases in selling prices during the year. C, timing, such as sales would be applied in calculating profits when or D, seasonal variations. For debtor days, the debtor days ratio is debtors divided by, is it owner's equity, sales on credit, total liability, or total assets? Okay, so for questions 5 and 6, once again, A, B, C, or D, please. Okay, questions 7 and 8. Which of the following would pose the lowest risk to the viability of the business? A cash injection of 50,000 through the issue of new ordinary shares. B, drawing down a new long-term loan of 50,000 from a bank. C, indefinitely deferring 50,000 euro payments to short-term creditors. Or D, pledging a marketable asset in return for the overdraft facility of €50,000. Question 8. Which of the following best defines the meaning of the term liquidity? A, the surplus of current assets over current liabilities existing in a business. B, the amount of cash held by a business. C, the relationship between owners' funds and borrowings. Or D, money owed to the business by customers. For questions 7 and 8, once again, you're answering A, B, C, or D. And the final 2 questions, 9 and 10. Which of the following best defines the meaning of the terms accounts payable or creditors? A, the money owed to people who have lent money to the business. B, any excess of current liabilities over current assets. C, the difference between total assets and current liabilities. D, the money owed by the business to suppliers, which is due to be paid within the next 12 months. Is it A, B, C, or D? And the final question, which one of the following best describes a current asset? Is it A, an asset which the business expects to convert to cash within a year? B, an asset which has been acquired within the last year? C, a sales order to be delivered within the next year? Or D, a delivery truck brought in last month? So again, for questions 9 and 10, is your answer A, B, C, or D? All right, so those are 10 questions that we posed to owner managers in a survey that we did in 2019 and wrote a report around their answers to those questions, but also we asked them a number of questions on how they use financial statements. Because what was really interesting within the Irish context was that while we talked about the poor performance of financial literacy amongst owner managers, there was actually no evidence to support it. So nobody had ever done a study to understand the issue. So in conjunction with the Small Firms Association in Ireland, I worked with them and we undertook a study, and the following are the key results that I want to share with you. That's a little blurry, but I'll be reading it to you. So first of all, we talked about the importance of financial literacy. And here's a really interesting graph, right, that we've kind of combined from across a number of different questions. When people were asked about the importance of financial literacy, 81% said it was either extremely important or very important, right? And actually, if you put in somewhat important, okay, well, you're up to 98. But look, extremely or very important, 81% think understanding finance is critical, right? It's really important. When we ask them about their own level of knowledge in terms of financial literacy, okay, in terms of expert or good knowledge, only 46% said that they had expert or good knowledge. And here's a really interesting statistic. When we asked them about how they rated other Irish business owners, how they rated other owner managers, they believed that 0% had expert knowledge and that 19% had good knowledge. So here's the story. When we asked people about their thoughts, 81% said it's really important. 46% said that we're either expert or really good. And yet they only thought that 19% of the rest of the owner managers were either expert or good. So we're good, but everybody else is useless. So part of what's happening here with this slide is, first of all, is that everyone's agreeing that it's really important, but the level of knowledge is really poor, and people perceive that it's others are the problem, not ourselves. Here's this finding that we got that you would expect, right? That in terms of the relationship between financial literacy and company size, okay, it was low to moderate, okay, for 2/3 of the small companies. Medium size, okay, it got better, and and then you will see that it got even better again for larger companies. It was a little lower, which was a bit surprising. But what happened there was that there was experts within those larger companies who were kind of taking responsibility, and the owner manager was leaving it to them. So we asked them about how many of you had financial training. 37% said no training, and 20% said they'd taken a short course. 9% said they'd trained as part of their Leaving Cert. So that'd be the equivalent of A levels, where it's your final kind of second level exam before heading to university, right? And where you take it, accountancy within a business-related subject, right? So it wouldn't mean that you'd have any great expertise in terms of accounting. So I just want to pause here, right? Because what we're looking at there is 66% of respondents either have little or no training in terms of financial literacy. Now, let's go back, to this figure, which said 81% thought it was really, really important. It was either extremely important or very important. And yet, 2/3 of respondents haven't really done anything about it. So, why are we having a problem here if you think it's so important? We then asked the question, how are monthly accounts used? And there was multiple answers possible, right? So that explains why there's more than 100%. You were offered 3 options. And 80% said they use monthly accounts because the bank needed the information. And if you look at the next set of results, right, only 1/3 see it as an opportunity to make make a business decision. Okay. And only 23% said, we use them to see how much money we have, right? So you've got a situation, again, where people perceive it to be really important, but they actually don't use monthly accounts in the way that they should be used or could be used. They only use it because they have to, because the bank asks for it. And that's on monthly accounts. When we look at annual financial statements, much the same is coming true. Why, when do you use financial statements? Okay, well, to understand the situation on a month-by-month basis. Well, the problem here is that you can't understand your month-by-month basis, from an annual set of figures, right, until it's too late. So if you're waiting for your annual results to understand the month-by-month figures, it's too late, The trend has already been happening. So let's just take a simple example where your annual year runs from January 1st to December 31st, right? So normally, small firms will give their accounts to their accountant at the end of the financial year, and it'll be maybe 3 months later before they get back the financial accounts for the year just gone, right? Financial year just gone. So sometime in March, you say, let's make it easy. Let's say it's March 22. I will get my financial statements for the year 2021. And now I'm reviewing them, okay, to see what happened on a month-by-month basis. But what happened in January, February, March of 2021, it's too late to do anything about it. It's too late to readjust, Here's the second reason why people use financial statements, because they must submit them to revenue for tax purposes. Here's, again, over on the side here, we can see only 49% say they use them to understand the year-end situation. Like, I'm wondering what the other 51% are doing if it's not to understand the year-end. 52% is to know the business situation at any time. And 51% is saying to make better business decisions. I would argue that making better business decisions would be, it's good to use financial statements, end of year accounts, but, monthly accounts would even be better. So why don't people use financial statements to inform, business decisions? Well, 42% said they let their accountants interpret the data. So if it's your business, why would you let the accountant interpret the data, right? Why is it their job? 42% said they don't understand financial statements. Now that bit, I believe. 41% said they're not trained to read financial statements. Fair enough. Why don't you do something else? Do something about it. 37% said they do not recognize the value of financial statements. And 31% said they have a mental block against financial data. And I must admit, I think those latter three are the real reasons why we have a problem with owner managers and financial literacy. There's a mental block there, about numbers, about why I as owner manager should understand the numbers and the value that they bring. And I think things like not getting training is just an excuse. So the next question was, why business owners don't spend more time learning to read and utilize financial statements? And 58% said, because it's the accountant's job. No, it's your business, right? It's not the accountant's business. They've got their own, practice. So 58% are saying, it's not my responsibility. It's the accountant's responsibility. But it's your company. Yeah, and again, issue like don't value understanding financial statements. Can you believe that 33% said, do not believe that it is their responsibility? Okay, 1/3 of people say it's not their responsibility to understand financial statements. Okay, I don't care what size your company is. Okay, it's your responsibility. I've got a really good friend who's a very successful entrepreneur who has a turnover last year of, I think if I recall correctly, it was 66 million euro. And every Friday, he has a 1-hour meeting with his managers to go through financial data. And he gets really upset when they spend money that doesn't need to be spent. Okay? And he's talking small sums of money, like relatively small in terms of 66 million turnover company, right? Because everyone is focused on the numbers, okay? Because it's led from the top down. Everyone is watching the numbers. So, things like I cannot afford relevant training, okay, or unable to locate training, like they're just excuses, So here are some of the areas of concern that were kind of arising. 55% of respondents did not calculate VAT on an ongoing basis, even though that needs to be paid. 51% of monthly accounts are not read on a monthly basis. So somebody produces them, but they're not read. So why do them? 51% do not know the gross margin or net margin per product of their service. Okay. So they don't know products or services that are bringing in higher levels of profit or lower levels of profit. And this is a frightening statistic, 26% of companies do not produce a debtor or creditor list. Okay. So again, when it comes to simple things like cash flow, like not having a debtor list, and not actually, you might even have a debtor list, but you've got to be ensuring that debtors are paying their money, okay, and that you're tracking them and that you're keeping debtors days down. Because my view has always been a sale is not a sale until such time as it's paid. Once upon a time, I did work with a company and they had 2.4 million turnover and they had outstanding debt of approximately 800,000 euro. About 1/3 of their turnover, okay, hadn't been paid. And when I asked the CEO why he wasn't out collecting outstanding debts, he said, well, if I demand the money from them, they may not buy from me again. And I said, so what's the point in them buying from you if they're not paying for it? This was heavy equipment, right? So if they were sending out equipment, very expensive equipment, and people were just using it and making money off it and not paying the company I was working with. I said, you got to get, knocking on doors and get that money in. Like, there's no point in making a sale if you're not going to get paid for it. So you can see here why there's such concern around financial literacy. These are all basics that will help improve the profitability of your business. It will help improve your chances of survival and growing and and making money. And all I'm asking is that each you have a monthly set of figures, that monitors a dashboard, like a car. You're looking at, when you're driving the car, you don't have to understand what's behind the engine, but you know how fast you're going. You know where, how much petrol you need. That, there's a gauge there for temperature. There's, you know how the lights work. There's a dashboard of important information that tells you how the car is performing without needing to know how the engine works. I'm not asking you to be an accountant. I'm just saying, please understand the numbers. So let's see how you got on. Okay, if you go to your answers, here are the answers for each of the 10 questions. Right? And what I've put here also is with the survey that was done in Ireland, here's the percentages of correct and incorrect answers. And as you can see, on occasion, it was, the correct answer was like only 1/3 of respondents. So the question on balance sheet number 3 was 33%. Profit and loss was only 34%. Viability was only 36%. The highest number of correct answers for any particular question was 57%. So those numbers, okay. Now, can I remind you, right, that of how many people said that they thought they were experts or had really good knowledge? And yet, okay, the numbers show they couldn't answer the questions. So what'd be really interesting for yourselves is to know how many you got right or wrong and what level of financial literacy you might have and whether you've got a need for training or not. So look, just some closing thoughts before I take some questions. These are some key messages that I want to bring to you today. One of the findings from the study that was, just made sense was that those who ranked themselves as having greater financial literacy scored higher on average than others. You'd kind of expect that to happen, wouldn't you? So basically, those who took training or those who were educated around financial literacy scored higher in terms of answering the questions. Well, you kind of expect that. What I'm clearly saying to you, right, is I don't expect you or a manager to be a qualified accountant. That's not what I'm asking. But I do expect you to understand the basics of finance. It's not just the accountant's job. You can't, just hand over responsibility like that to the accountant and say it's their job. It's your business. And you should be able to understand the basics of finance. Please, 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 and I'm really emphasizing that, take a course on financial literacy. Okay, you will immediately see the rewards in terms of understanding your business and understanding how it enables you to make better business decisions, understanding how profitable certain segments of your market might be, or certain customers might be in comparison to others, or where you should be putting your energies. All I'm asking is for dashboard monthly figures such as sales, costs for that month, the profit for that month, how much cash is in the bank. Okay, cash is king, right? And you've got to understand the difference between sales and cash. They are not the same thing. And I keep coming back to a sale is not a sale until you get paid. So sales and cash flow are completely different. You've got to understand that. And knowing how much cash you have in the bank and how your ability to pay credit, to pay your bills, how much money is in the bank to be able to do all that. And you've got to have a debtors list regarding money that's owed to you. And more importantly, you've got to be chasing after those debtors and getting your debtors days down. The debtors days being the number of days on average between invoicing someone and getting paid. Now, normally there's a 30-day period that allows for people to pay. And, sometimes people might stretch it to 2 months. But anything after that becomes unacceptable. And you should be getting your debtors days down to 60 days or lower. A tough task for many people. Understanding financial statements help you to make better business decisions. As I was trying to emphasize with my case study at the beginning, by understanding what the key goal was, whether it's revenue or net profit, whether it's where we're making money out of our clients, it just helps you to make better business decisions, not just financial decisions, but better marketing decisions, better operational decisions, and even within manufacturing or other forms of other functions of business, you'll find that understanding finance will help you to make better decisions. As I've said on a number of occasions, which customers are making you the most or least amount of profit? Where should I be putting my energies? Where should I be putting my targeted marketing campaigns? Increase your cash flow by reducing your debtors. Get money in quickly. And I assure you that there are many other great reasons for understanding of basic financial numbers, which, as you become more adept at financial literacy, you will appreciate and find that it's just making so much more sense for you and how you run your business. So I'm going to stop sharing there. Can I just let you know that the organizers have a copy of my slides I'm quite happy for my slides to be shared. And the and please feel free to come back to me with any questions that you might have, because I'm quite happy to answer any queries that might follow up from this. I see a question there on financial literacy. What would you recommend for self-employed entrepreneurs? I do know that there's a course, let me check this out. There's a course on an EU-funded project. It was a DIFME project. Just not, if you give me just some, I'll take other questions while I'm just checking the web address for this. It was an EU-funded, and it's basically targeted at owner managers. If you go to DIFME, DIFME, I'll type it in, .eu. I do know that it was a, there, if you go there, I do know that project was all about developing financial literacy tools for owner managers, and that they developed a range of online modules to help you to understand financial literacy. So I would check there. I would also hope that each country would have, that if you go to your enterprise support agency, I know here in Ireland that it's become a huge concern, and that they are now delivering financial literacy programs for owner managers, and other countries might be doing the same. But start with difme.eu. Any other questions?
Yes. What is your take on the focus on fundraising on the valuation of companies tech these days? And can we have your email address?
Yeah, for sure. Well, the email address one is easier. Now, in terms of fundraising, we got a number of problems. I just did a report last week, which was launched by WeGate. It was for WeGate, and it was the We Barometer, and it was a survey of women entrepreneurs across Europe. And unfortunately, access to women entrepreneurs remains a serious issue. And in terms of venture capital, and it was an even bigger barrier, right? And it was a bigger barrier for a number of reasons. One is that women entrepreneurs themselves felt they didn't have the confidence or the skill set. And actually, number three was a fear of an expectation of gender discrimination when it came to venture capital funding. Now, that expectation of gender discrimination is actually based on a reality, because there is quite a lot of evidence to show that a panel of venture capitalists reviewing a proposal for funding, that the venture capital funders, the more men on the board, are on the panel, that are on the panel, the less likely there is that the female entrepreneur will get funding, right? And equally, the more women there are on the entrepreneurial team approaching the venture capital funders, the less likely they are to get funding from venture capital. So what we're getting is a situation where venture capital tends to be dominated by men giving out the money and perceiving that the world through their eyes. And unfortunately, there's a gender bias that's happening that's making it difficult for women to access funding. And I do know that there are people who are trying to change that, working very hard to change that. But that remains a barrier in terms of the question that you asked. Access to funding is hugely difficult, and even more difficult for women entrepreneurs.